Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak podcast, available every morning on Apple, Spotify or wherever you listen. It's Friday, the 25th of October in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, harassment in the city. A regulator's survey finds a 72% surge in misconduct claims in 3 years.
Tax rise signals. Keir Starmer says people who get their income from stocks are not working people.
Plus, China in a bull shop. The financial elite pour cold water on Beijing's stimulus plans at the IMF's annual gathering.
Let's start with a roundup of our top stories.
Harassment claims at city firms have soared, according to a new survey from the Financial Conduct Authority. Bloomberg's James Woolcock has the story.
It's the biggest review of discrimination and bullying claims in the square mile ever conducted by the city regulator. Businesses reported a 72% surge in non-financial misconduct claims over the last 3 years, with bullying and harassment the most reported internal complaints. The survey of more than 1,000 firms comes after a string of high-profile scandals, including sexual harassment allegations levelled at hedge fund chief Crispin Odey, who has now rejoined his hedge fund following the claims. The watchdog stopped short of announcing new requirements. In London, James Woolcock, Bloomberg Radio.
UK Prime Minister Keir Starmer says that those who make money from their assets don't count as working people. The comments come ahead of the government's budget next week, where taxes are widely expected to increase. The Prime Minister was asked who would be protected.
What I have in my mind's eye when I make decisions as Prime Minister are the sorts of working people who go out, work hard and maybe save a bit of money, but don't have the wherewithal to write a cheque to get out of difficulties if they and their family get into difficulties.
So that was Keir Starmer speaking there. Ahead of the budget, UK consumer confidence has fallen to minus 21 in October as households have turned more downbeat about the broader economic outlook. The spread between UK and German government bonds has risen to the highest in a year on an announcement by the Chancellor yesterday that she would boost her borrowing headroom by £50 billion.
China's recent stimulus measures fall short of what's needed. That's according to central bank governors and finance ministers at the IMF's annual meeting. Critics argue that the stimulus fails to address key issues such as overcapacity and weak domestic demand and lacks a clear plan to boost consumer spending. Bloomberg's Rebecca Chung-Wilkins says many analysts think the country is opting to wait and see.
As we see this risk of a looming trade war, potential full-blown trade war with the EU, as well as a potential chaotic Trump presidency, China's really trying to sort of hedge its bets and play nice with a series of key countries.
Bloomberg's Asia government and politics correspondent Rebecca Chung-Wilkins there. Although senior Chinese central bank figures were at the IMF meetings, none of those involved in Beijing's stimulus rollout give any public comments.
Some of Europe's central bankers are starting to openly discuss cutting rates by 50 basis points in December. Their more hawkish colleagues say that that's far too hasty. Belgium's Pierre Wunsch is one of them.
I know some of my colleagues are already discussing cutting 50 basis points in December. We'll have 2 more readings of inflation before we have new projections. My take on it is, of course, the European economy is weaker than we thought, and we had an inflation surprise on the downside in September. But I don't see why we should today have a discussion on a 50 basis point cut in December. I think really it's premature.
So premature. ECB Governing Council member Pierre Wunsch was responding on Bloomberg to comments from Portugal's Mario Centeno and Latvia's Martins Kazaks, who say that the ECB should make major cuts to support the economy. Watching the policymakers are the money markets. They now almost are evenly split between positioning for 25 or 50 basis point rate reduction in December.
Andrew Bailey says clearinghouses pose a risk to the financial system if not properly operated. The Bank of England governor made the comments on the sidelines of the IMF annual meetings in Washington, arguing that central counterparties should be able to manage the shock of a bank failure by mitigating credit risk. However, Bailey also noted the risks of unsafe clearing, added that it would be worse than no clearing. The practice became a political flashpoint post-Brexit as the UK battled to retain EU clearing activity. A deal earlier this year ensured much of that business will remain in London.
Now, UBS's CEO says that fragmentation in Europe's banking markets is increasing borrowing costs and suppressing shareholder returns. Speaking to Bloomberg, Sergio Amotti says the economy is losing out as a result.
At the end of the day, the cost is paid by the economy, by clients. I think, of course, shareholders are suffering, but eventually cost of borrowing and the facility and the easiness of accessing credit is impaired. So allowing capital to freely move across jurisdictions creates less cost for the economy.
UBS CEO Sergio Amotti speaking there to Bloomberg Television. Banking supervision and regulation across the EU's largest firms was harmonised following the financial crisis, but the region has still failed to create one single banking market. In a moment, we'll bring you more on the hints about next week's upcoming UK budget, plus how China's efforts to stimulate its economy are not impressing global financial leaders. But first, a word on another story that we've been reading about this morning. It's about Macquarie and a new building, a new HQ they have.
I thought that London excelled at nicknames for new buildings, you know, the gherkin, the cheese grater, the walkie-talkie, but it has a competitor now in Sydney. Obviously, the sense of humour translates well underground because Macquarie's new headquarters has been nicknamed the Minion because it's rounded at the top, a sort of a circular building. It's got Macquarie's circular logo on it as well, but it is making a reference to locals anyway. People are looking at it like the cartoon characters in the Despicable Me movie franchise. Yeah,
absolutely. I'm not sure whether this will be entirely welcomed. I mean, I've also heard it referenced as the Death Star or as a Dalek. So the Minion is perhaps the kind of gentlest version of it. But look, the 40-storey building was meant to be much more low-key, right?
Yeah, well, I mean, look, this is at a time when the debate is ongoing in Australia, as it is here in London too, about how much office space these businesses need as well. Macquarie doesn't have a firm-wide policy about office attendance for its more than 20,000 employees worldwide. There are 9,000 of them expected to be based in this new office in Sydney as well. But it is an issue actually in the market there where premium office space has quite a high vacancy rate, nearly 11%, in the centre of Sydney, and this is an issue in the market too.
Yeah, absolutely. Michael Silman, Macquarie's head of corporate real estate, said in an interview that the firm wanted something that was not ostentatious or loud. I'm not sure that was the result, but anyway, there we are. One fun, interesting story on the Bloomberg terminal.
We're going to come back to the City of London next and this new survey by the UK's Financial Conduct Authority looking at non-financial misconduct at firms here in London. Our reporter Tiwa Adebayo has been looking through the details of it. Tiwa, can you break down for us the details of this survey? What kind of behaviour was being tracked and what do the results show?
Well, it's the biggest review of discrimination and bullying claims in the City of London that's ever been conducted by the Financial Conduct Authority. So it's really looking at those non-financial misconduct complaints. It's very significant, actually, because it's one of the first surveys which actually supports the sort of widely held concerns that not very much has changed since the Me Too movement in terms of workplace culture in the City of London. So just looking into the data, the kind of big headline figure really is that city firms reported a 72% surge in non-financial misconduct complaints over the last 3 years. In terms of those complaints, bullying and harassment are the most reported. Looking at the sectors that they surveyed, banks had the highest number of total incidents, and they also fared the worst as a proportion of total staff members. The FCA has, however, issued a caveat and said that the uptick could be as a result of people becoming more comfortable with reporting these issues. And also it said that they could have been slightly skewed by the pandemic too. But just looking further into the data in terms of the firms, they surveyed more than 1,000 brokerages, corporate investment banks and insurance-related firms. And actually a Bloomberg Freedom of Information request, interestingly, shows that more than a quarter of those firms missed the initial deadline to respond to this survey. So some interesting figures revealed today.
What prompted the regulator to carry out the survey to ask these questions?
Well, Caroline, it comes off the back of a string of high-profile scandals. Last year, for example, there were several claims of sexual misconduct and toxic culture at the CBI. There were also high-profile cases, including the allegations of sexual harassment levelled at hedge fund boss Crispin Odey, which he denied. Just yesterday, it was announced that he's returned to his role at what remains of his hedge fund. But also earlier this year, there was a report by the Treasury Committee into sexism in the city, and that found that efforts to tackle sexism are moving at what it said a snail's pace, and it called for the end to this era of impunity, as it describes it. So there were several catalysts for this big survey.
What's the FCA planning to do about this problem? What's it said about the results?
Well, it's worth mentioning here that the FCA is much more accustomed to taking down, say, rogue traders and dealing with financial wrongdoing. So not perhaps a problem that there is much precedent for the regulator to deal with, but they are trying to grapple with the scale of the problem. In terms of their response to the results, they've stopped short of announcing new requirements. They're actually suggesting that companies use these results as a catalyst to see how they compare with peers. They've also said that they're going to follow up with those that reported no incidents of bullying and harassment or non-financial misconduct complaints in those 3 years. But it really is consistent with what we've seen from the FCA in terms of diversity so far. After that March 2024 report on sexism in the city, it was actually recommended that they drop the FCA drop the requirements that they had proposed for firms to disclose data on diversity for fear of it becoming a sort of tick box exercise. And they responded to that by saying, they really want to have flexibility at the heart of any diversity requirements that they put onto firms. And this response, kind of leaving it up to firms to adjust their conduct and how they manage things, is typical from the FCA.
Okay, interesting. Tiwa, thank you so much for being with us this morning. That is our reporter Tiwa Adebayo then on the FCA, the City Watchdog's investigation and survey into discrimination, bullying in city firms.
Well, let's stay in the UK now and bring you up to date on the latest news on the budget. The Prime Minister has hinted at tax rises for investors, while the UK's borrowing costs rose yesterday after the Chancellor announced changes to the fiscal rules. Our UK correspondent Lizzie Burden joins us now for more. Lizzie, let's start with what we've been hearing from Keir Starmer. What's he said about taxes?
Well, you remember that the government's promised not to raise taxes on working people, but controversially, and I wonder how many of our listeners agree with this, he says that doesn't include people who derive their income primarily from assets. Now, there is widespread expectation that employers are going to pay more national insurance and that capital gains and inheritance taxes will go up. And if you have an increase in capital gains tax, that's likely to impact people selling property as well as shares. So I would actually really recommend the latest episode of the Bloomberg UK Politics podcast. We broke all of this down with the chief UK economist here at Bloomberg Economics, Dan Hansen, and he tells you how much it all adds to Rachel Reeves's war chest.
Yeah, absolutely. We did a great episode, didn't we, Lizzie? It was a quick fire round of which taxes Dan Hansen expects things may go up, plus all of his deep analysis. In terms of Rachel Reeves, the announced changes also to the fiscal rules to allow more borrowing for investment. Another major question around the budget. What has been the reaction to this announcement?
Yeah, she's confirmed that she will change how debt is measured so that she can maintain this golden rule of funding day-to-day spending with tax revenues, but borrow more to invest. So she's towing this line between maintaining fiscal credibility, finding space to avoid raising taxes on working people, and not returning to austerity. So it's a really tight set of limitations Labour set themselves in order to get elected. And it is absolutely crucial that she can convince markets that this borrowing is going to stimulate growth, hence why she's doing all the pitch rolling at the IMF, in The Guardian, in the FT opinion piece she did as well. And yet you saw the market market wobble yesterday. The yield on 10-year gilts falling, the spread between gilt and bund yields widening, and that's because of the prospect of increased borrowing, leading markets to pair their bets on the scope for BOE rate cuts next year. And that at first seemed at odds with Andrew Bailey kind of saying that disinflation's happening. He'd said that that was a condition for more aggressive cuts. And now, with a bit of hindsight, you can see that this was more of a fiscal story than directly a monetary one.
Yeah, I mean, looking across the closing market figures yesterday, the contrast quite stark in European bonds, that gilt yields were rising when they were falling across the rest of the European bonds. Lizzie, let's talk about kind of the significance of this event for this government. Their first big test.
Yeah, and this is an enormous historic moment. It's Labour's first budget in 14 years. It's going to change how the economy's run potentially, and it's the first ever by a female chancellor. When you think about it, as I say, they've made this task impossibly hard for themselves, and it seems like they will raise lots of taxes, just not the three main levers of income tax: VAT, national insurance on employees, or income tax. They're going to change the fiscal rules and yet hope to maintain credibility in markets. And we're just going to have to see whether they commit to enough spending that it doesn't feel like a return to austerity.
Yes, very difficult task ahead. We will have full coverage, of course, for you of the budget on Bloomberg Radio and television next week. Thank you, our UK correspondent, Lizzie Bird. Right, let's turn our attention to focus on China next. And the country's recently announced plans to stimulate its economy, which have failed to impress global financial leaders gathering in Washington for the IMF and World Bank meetings. This as new figures show defaults in one part of China's local government debt market have surged to a record high. Our news desk editor Jill Deesis joins us now from Hong Kong for more on this. Jill, good morning. Let's start with the story around debt. What sorts of products are we talking about? How significant are these defaults?
Yeah, good morning, Caroline. So this is a really opaque corner of the local debt market in China that we're looking at here. So these are failures of what are called non-standard products that are surging to record levels. And it's really difficult to keep track of exactly the size of this market because these are fixed income investments that aren't publicly traded. So a lot of what we rely on to actually get a sense of how much is actually defaulted comes from analysts that are estimating the amount at about $800 billion, the equivalent of $800 billion US dollars. So, not absolutely tremendously massive, but still obviously pretty incredibly high here. And what we're also seeing there, just according to some data providers that we've spoken with, is that through the first 9 months of this year, you're seeing about a 20% increase of defaults of these types of non-standard products, 60 tied to local government financing vehicles that have either defaulted or warned of repayment risks. So there's a lot of concern here just in terms of the size of the defaults that we're actually seeing, and then how ultimately that really sort of spreads back into the economy, into these concerns about local debt risks in China, which, as we know, are quite significant and pretty prolonged.
Yeah, indeed. And, we focus on this story because we know that it's been one of those kind of risk areas in the Chinese economy as well. How does it feed into the broader picture of what's going on in China?
So this all really kind of goes back to the fact that these types of products are tied to investments made through local government financing vehicles, or LGFVs. Municipalities around China have traditionally used these types of financing vehicles to fund everything from, major infrastructure projects, including roads and ports and all that kind of stuff. These have actually been, over the last several years, a pretty significant part of what China's actually done to continue encouraging economic growth. I mean, investment in infrastructure in particular, that's classic China playbook of how do we actually get, growth stimulated in the economy again. And so, a big concern over the last couple of years has just been how much these LGFVs are kind of, getting away with this runaway debt that's not actually being, properly calculated. So if this issue continues to be a problem, or they're not able to address some of these debt risks, then you kind of risk a lot of this impacting these local municipalities that may not then have access to financing to actually finish some of these projects that they've started.
Now, at the IMF meetings in Washington, there's also been much discussion about China's efforts to stimulate the economy. I mean, there's been both open criticism from the likes of the US Treasury Secretary and the IMF has concerns. And there are also, according to Bloomberg reports, been a lot of conversations behind closed doors as well. What have they been saying? What is the feeling that has emerged from those meetings in the US?
Yes, well, it sounds like, from what's been happening in the U.S., at this IMF meeting in D.C., is that a lot of these concerns are actually very similar to what investors, traders, economists, analysts have been expressing over the last several weeks, which is that, there's, been this effort by China to introduce a lot of monetary policy to help stimulate the economy and affect growth. But there hasn't really been a whole lot of concrete actions taken on the fiscal side of the equation. And that's been something that's, really, really worried investors in particular over the last several weeks. We saw a big spike, a lot of run up in China's stock market after the monetary policy stuff was announced, but there hasn't really been that follow through. And so what you're hearing from people like Janet Yellen, the Treasury Secretary, the U.S. Treasury Secretary, for example, is that, there hasn't been a whole lot in the stimulus package that actually tackles a lot of longer term problems for the Chinese economy, like overcapacity has been a big thing that the U.S. has really been nailing China on. And she's also saying that there's a lot of concerns over the fact that this doesn't really do a whole lot to address weak domestic demand in China. Ultimately, this kind of come down to this idea that China has so far introduced enough stimulus to maybe get them over the line of a 5% growth target for the year. But there's a lot of concerns about whether they can actually push that forward into 2025 and actually address some of these underlying systemic issues.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.